bringing about all this, because the process is very transparent. The consultation process and feedback and comments, and then they are to be processed, and every single comment has to be looked at, and then we take a balanced view in the board. So this comprehensive review, whenever we take, it may be time intensive, but it also is very much effort intensive. So I'm glad that we have been able to successfully take up 2 such proposals in this board meeting and clear it. So the first of all is the stock brokers regulation, which is, as you know, it 1992 regulation. And so therefore it is coming after a considerable period of time with a total comprehensive review. First of all, just to give you a scale, this particular regulation was 59 pages, which is now coming to 29 pages, which is about 50%. And also in terms of words, it was about 18,846 words. It's now 9,073 words, so that's about 50%, again, reduction in words. In terms of objectives, the first one has been the streamlining the regulations to ensure that the language remains simple, enhancing the ease of understanding. So the first is simplifying language and ease of understanding. The second thing is to bring more clarity, ease of compliance, and ease of doing business. Third objective, omission of repetitive, redundant provisions and alignment with other regulations. Fourth, updating the regulations with contemporary changes. And fifth, omission of forms which may be prescribed by way of circular. So there have been several changes. Major principles of compliance requirements, which have also been mentioned, which are applicable to stockbrokers, have been included in the regulations. For example, protection of clients' funds and securities, risk management and internal control, and compliance with cyber security and cyber resilience framework, etc. Around 702 comments were received on the various provisions of draft regulations, and several suggestions were also received. After taking into consideration all of that, we have been able to make these regulations. The second, maybe you may have some questions, or you would like to say what all is contained in that. But I've just given you a broad framework within which this has been attempted. The second comprehensive review has been done, that of SEBI Mutual Fund Regulations 1996. So the new SEBI Mutual Fund Regulations is also a comprehensive replacement. It's coming after many years. For nearly 3 decades, it has served as a foundational regulatory architecture, but there have been several amendments, and now we wanted to simplify and consolidate. So, in terms of, again, the focus has been on simplification and consolidation, transparency and investor protection, and then we have also taken some important measures in respect of changing the caps, which is on the total expense ratio, bringing clarity on statutory levies, rationalization of brokerage limits, and disclosure of total expense ratio. There is also a reduction of about 44% from 162 pages to 88 pages. Word count has been reduced by approximately 54% of current regulation, from 67,000 words, including footnotes, to 31,000 in the new regulations. So here, important points, as you know, are the clarity on statutory levies. So expense ratio limits, now called base expense ratio, shall exclude all statutory levies, Statutory and regulatory levies such as STT or CTT, as the case may be, and GST, stamp duty, SEBI fees, exchange fees. These will be incurred for execution of trade shall be charged on actuals over and above permissible brokerage limits. So total expense ratio will be equal to BER, which is the base expense ratio, plus brokerage, plus regulatory levies, plus statutory levies. The important objective of this exercise was to make it transparent, because the taxes and levies are subject to change over time, and they should not remain embedded in the TER. In current case, something was embedded, something was not embedded. So there was a confusion. So this confusion has been clarified. And the base expense ratio has now been adjusted. In your press release, you have the table. There were, I think you will also come to some of the points. Initially there was a proposal, and now present proposals, there has been change. The reason is that after the consultation paper, a number of representations was received from different stakeholders, and taking into consideration the balanced view has been taken in these. So, for example, the brokerage cap is now 12, which was existing is 12 bips, including statutory levies. This will now stand reduced to 6 bips, exclusive of levies. And derivative transactions, the existing is 5 bips, including statutory levies. The cap is now reduced to 2 bips, exclusive of levies. On AMC also, so far as the AUM slab-wise rates are there has also been adjustment. But broadly, we can say that the incidence remains the same, excluding and including, more or less, except for a couple of slabs. But main change is that 5 bips on exit load has been removed. The other point is the ease of compliance, rationalization of reporting requirements, elimination of duplicate filings, digital first disclosures, streamlined borrowing framework. And this is an important point, enabling borrowing by equity-oriented index funds and equity-oriented ETFs for execution-related needs, and clarifying the permissibility of intraday borrowing mechanisms to manage redemption-related timing mismatches. This was an important point which was brought to our notice by the industry, which has been redressed. The third important point which has been taken by the board today is in respect of certain amendments, certain requirements relating to public issue to enhance ease of doing business and increase the engagement and participation of retail investors. So the first of all is that this issue of how to focus retail investors as well as the others to focus on IPO's important points. IPO documents being DRHP, being very, very big documents, it's difficult for them to focus and know. So therefore, we wanted it to bring a focus, and consultation paper was that, okay, let's have a summary, offer document summary, and then that should be highlighted. Now, the board has, of course, taken a view that instead of that, we can have similar objective fulfilled through abridged prospectus. Because abridged prospectus is also a requirement under the law, under Section 33 of the Companies Act. with application, you have to give an abridged prospectus. So this is a legal requirement, so we cannot remove abridged prospectus. So what we say is the abridged prospectus, we have now said that this will be XYZ. Like we have created all important points which are required, and we have given that format that this abridged prospectus will be containing all these important points. And this will come, today this is not being offered at the draft stage. So we are saying that the draft stage also, when you have a DRHP, at that stage also there will be a draft abridged prospectus, which exactly will bring everything together, and it will be available with a QR code, so that, and this was one of the suggestions from public feedback, so that all the public announcements related to that IPO will get that QR code, so that the people can easily access that abridged prospectus, which will now get all the information which your eyeballs need quickly. And idea is that the people are able to read through they are not able to read through the voluminous IPO thing, but still we need people who are doing a lot of research. For them, I think we need to give everything. But for the people who quickly want to really assess all the relevant information, we have indicated that it should be placed in the abridged and with a QR code, so it can be easily done. So the only change is from the document which was sent for public consultation and today is that there we wanted the summary to be highlighted and abridged to go. Here we are saying that let the abridged will be retained and it will come at the draft stage itself. And then I think in consultation with Ministry of the Corporate Affairs, we can change that, and offer document summary can be removed from there, so that not to be repetitive. I hope it is clarified, but I will also clarify you while you are taking questions. Then the next, I think there was one more thing in this. There was a very important, enabler now to bring in an automatic lock-in for the pre-issue capital. So there are shareholders, there are promoters whose shares are locked in for 6 months, but there is also a requirement that those who are even not non-promoters, their shares also will be locked in for 6 months. The problem happens that if the things are pledged, then how the pledge will work. And that was leading to many of the companies not being able to get that clearance from those shareholders, those who have pledged it, so that these lock-in requirements could be filled up. So we are making a provisions in the changes in the ICDR, and based on that, there will be a possibility that directly the depositories can do the work, and pledged work can release of or taking off the pledge will automatically lock in will be possible through the depositories. So these are the two proposals relating to which will have impact on IPOs and IPO processes. Then the next proposal is to permit debt issuers to offer incentives in public issues to certain category of investors. So currently the issuers of debt securities are not able to offer incentive to any persons for making an application on the issue, except for commission or the brokerage. But if the issuers want to give certain facilities, certain discounts, that's not permissible. So we are, in order to promote retail, buying for the bonds or the securities, the non-convertible securities, we are making the amendments to make it possible for the additional interest or a discount to the issue price to be given to certain category of allottees. For example, senior citizens, women, armed forces personnel, namely serving and retired defense personnel, and widows and widowers of such personnel, retail individual investors, or any other category of investors as may be specified by the board from time to time. So this will enable something which is already possible under the equity segment to also be possible for the segment on the debt side, non-convertible securities. And the next item is relating to Regulation 39 and 40 of the Listing Obligation and Disclosure Requirements Regulations. The basic thing is in removal of, the first is 39, in which we are now bringing in a simplified way in which the physical, in which the transfer deeds executed before 1/4/2019 could be dematted. Now, as you know, after 1/4/2019, no transfer is possible other than demat. But if the physical securities were there and transfer was there, there was a up to 2021. It could have been, it was possible to lodge it and then get it converted. Now, some of the difficulties have been faced, and those difficulties are being addressed in these regulations. So, before 1/4/2019, if you have lodged the claims and if you have, it was in one case something rejected or returned earlier, then we have given already a special window has been opened from July 7, 2025 to January 6, 2026 to allow relodgement of transfer deeds which were executed and lodged prior to the deadline of April 1, 2019. However, if we also have some cases where transfer deeds were done before 1/4/2019, but they could not lodge it before the time 2021 which was given. So therefore, we are opening this window for them in order to come in and lodge it. Please note that it is a pre-1/4/2019 transfer that we are talking about. Post that, transfers in physical securities are not allowed. The next is the aligning the timeline for transfer of unclaimed amount by an entity having listed non-convertible securities with Companies Act. So this is where, as you know, that there is an Investor Education and Protection Fund, IEPF, and investor, then it is also there at Ministry of Corporate Affairs. It's also available with the SEBI. So in case of companies, any unclaimed amount of maturity and interest has to go to, after 7 years, has to go to that fund. There was inconsistency that here there is a debt, for debt securities there is a principal and there is also an interest. So interest is accrued over a period in several tranches. And the 7 years timeline was to be, as per the rules of the IAF, was coming from 7 years from maturity. So this was not very clear. This is being aligned so that there is no confusion. This will also enable many people to claim interest from the issuer itself, because there is generally a little more difficulty in getting that from the IEPF. That's a separate set of rules. So now it will go, the interest, the accrued interest which is there, it will go to an escrow whenever it is to be paid. If not paid, 30 days, within 7 days it goes to escrow. But it doesn't immediately after 7 years go for that. It waits till the maturity. From the maturity, it goes 7 years. The matured principal plus all the interest which is there together can go until the time it remains in an escrow with the issuer, which means that the claim would be possible from the issuer as and when the people are able to track it and trace it. So generally, due to various reasons, the interest is, people are not able to get the interest. It may be change of address. It may be they would have shifted locations. They may not be aware of the physical thing, and as and when they are aware, they can go and claim. But that amount should be available, and that amount will be available in escrow with the concerned issuer. So this is basically to realign to align with the IEPF rules. Then the next decision was relating to the regulation of activities of credit rating agencies. So the credit rating agencies, which are regulated by SEBI, can also fall under the purview of other financial sector regulator. They may be, for example, rating loans, etc., which is a purview of RBI. They may also be doing some work relating to, say, unlisted securities, which is not really being in the purview of SEBI. So there was a difficulty faced by the industry in terms of not being able to, because of our provisions, which said that they can do so only if there is a guideline by the concerned financial sector regulator. Now, in absence of a guideline, they could not have done it. There are in many areas where there are no guidelines from that concerned regulator, which means they were not able to do it. So we are making it now clear to enable them to take up such activities, but making it very clear that what would be the disclaimers and conditions which will lie, which means that basically they'll segregate certain business processes in a manner where investment protection and other benefits of SEBI will not be available in relation to non-SEBI regulated activities that they do, and they have to make it explicit. They also have to intimate. They have to have a separate email IDs, etc., for those clients. And subject to that, they can actually take up those activities. So this is something which is an important area in which they can do, and that will also be good for the economy, because in many cases there would be unlisted entities also for listed players also. There could be subsidiaries. So in which case they normally rating, when it is done, it's also done on a company on issuer and consolidated basis, including subsidiaries, including unlisted entities also, which was a difficulty so far as they were concerned, that our regulations were in a way preventing them from doing so. So we are removing that. It's an ease of doing business measure, subject to, of course, the due risk mitigation, which they will do. Like if they have to take up additional net worth would be required if certain other regulator says so. So that will not be merged with this net worth. So there are certain safeguard measures. Subject to that safeguards, they can do that. The next item was relating to high value debt listed entities. As you know, HVDLEs, they are the ones who have been classified today with an outstanding, of non-convertible debt of 1,000 crore or more. Now, this limit is actually very low in relation to the debts that many of the entities raise, for example, NBFCs, etc. So there is a constraint on them. So that's being raised to 5,000 crore. And so this is an ease of doing business. What happens with the HVDLEs is the additional corporate governance requirements. And those corporate governance requirements would be extra costs also to them. and obviously more onerous measures, and will dissuade them otherwise to do that. So that is one set of proposal. The second set of proposal is to make those corporate governance measures consistent with what is obtaining on the equity side. Because what has happened is that last few boards, we have relaxed those requirements there on the equity side. But consistently, we have not done it here. So we are aligning it with that. So if for example, if you have a issuer who is also on the equity as well as on the debt, there's a consistent provision should apply instead of. So we have basically harmonized it with whatever ease which we have given it. For example, RPTs, whatever scale-based RPTs we have applied there, we are also applying it there. So this is basically kind of a catch-up and harmonization. The other is raising the threshold from 1,000 to 5,000 with a view to further enabling this sector to raise the debt easily. The last important proposal was relating to the high-level committee on conflict of interest. So the board deliberated on this matter, and it's and acknowledged that there is a comprehensive review which has been carried out by HLC, and expressed that we need to have a detailed discussion on the recommendations in the ensuing meeting, keeping in view public and media comments, certain concerns expressed by employees, operational modalities, and the way forward.